Hello, entrepreneurs. Today we're going to talk about one of the most important decisions any business owner has to make: choosing the right business structure. Did you know that a decision as simple as this could save you thousands of dollars in taxes each year? That's right. Whether you're new to the business world or already an experienced entrepreneur, this information is key to your success. In this video, we'll break down the differences between being a sole proprietor and forming an LLC so you can determine which option is best for your specific situation. Not only that, but we'll also provide practical examples, tips, and factors to consider before making your decision. Don't forget to subscribe to this channel and activate the notification bell. If you're looking to optimize your taxes, protect your assets, and take your business to the next level, this is the place for you. Let's get started. Before diving into the details, let's define what it means to be a sole proprietor and what an LLC is. These are the two most common business structures for small businesses in the United States, but they offer very different benefits and drawbacks. Sole proprietor. This is the simplest and most basic business structure. As a sole proprietor, you and your business are the same from a legal and tax perspective. There is no separation between your personal assets and those of the business, which means you are responsible for all debts and obligations that arise. LLC, Limited Liability Company, an LLC, on the other hand, is a separate legal entity that offers personal protection and tax flexibility. This means that, in most cases, your personal assets are protected if the business faces debts or legal claims. Choosing between these two options might seem straightforward, but there's much more to it than meets the eye. From the taxes you'll pay to how you protect your personal assets, your decision can significantly impact the success of your business. Let's dive in. Now that we know what these structures are, let's do a detailed comparison of their advantages and disadvantages. We'll break it down into four main categories: taxes, legal protection, costs, and flexibility. 1. Taxes. Sole proprietor. As a sole proprietor, all your business income is reported on your personal tax return using Form 1040. While this simplifies the process, it also means you'll pay taxes on all net income, even if you decide to reinvest money into your business. For example, if your business generates $50,000 in net profit, you'll pay taxes on those $50,000 plus Social Security and Medicare taxes. LLC. An LLC offers more tax options. By default, a single-member LLC is taxed like a sole proprietor, but you can also choose to be taxed as a partnership, an S corporation, or even a C corporation. This allows you to tailor the tax structure to your specific needs, potentially saving you significant amounts of money. 2. Legal protection. Sole proprietor. A major drawback of being a sole proprietor is that you have no personal legal protection. If someone sues your business, they could go after your personal assets, such as your house or savings account. LLC. An LLC, on the other hand, creates a legal barrier between your personal assets and those of your business. This means that, in most cases, you will not be personally liable for the debts or lawsuits against your business. 3. Costs. Sole proprietor. This structure does not require formal registration or initial costs. It's ideal for those starting on a tight budget. LLC. Forming an LLC involves initial registration costs, which vary by state, and annual fees to maintain the entity. For example, in some states like California, the annual fee can be $800 or more. 4. Flexibility. Sole proprietor. It's ideal for simple and small businesses with a single owner. LLC. It allows you to adapt as you grow. You can add partners, change how you are taxed, or even convert into a corporation if needed. To make these differences clearer, let's look at two practical examples. Case 1. Maria, sole proprietor. Maria runs a consulting business from home and generates approximately $50,000 a year. Her business has no employees or significant legal risks. As a sole proprietor, Maria can keep her costs low and simplify her accounting. Case 2. John, LLC. John runs an online store with annual revenues of $100,000. Since he deals with physical products and shipping, he faces a higher risk of legal claims. John chooses to form an LLC to protect his personal assets and opts to be taxed as an S corporation to save on taxes. When deciding between these structures, you should consider expected income. If you plan to earn less than $50,000, a sole proprietor might suffice. If you expect higher earnings, an LLC could offer more tax benefits. Legal risk. If your business has a significant risk of litigation, an LLC is the best option to protect your personal assets. Business growth. An LLC is ideal if you plan to expand, hire employees, or seek investors. Initial costs. Assess whether you can afford the initial and annual costs of an LLC. Choosing the right structure depends on your specific goals and needs. If you're looking for simplicity and low costs, a sole proprietor might be suitable. But if you value protection and flexibility, an LLC is a smart investment. Let me know your thoughts and any questions in the comments. I'll be happy to help. See you in the next video. Don't forget to subscribe and hit the notification bell.